would say my call of the day is hopefully, it's my prediction that the vote that happens today on the House of Representatives is going to be broadly bipartisan. That's my call. Hold me to it, and I'm excited to see what happens later today.
Good morning, everyone. It's Wednesday, May 22nd, 2024. Happy Bitcoin Pizza Day. I wish I could send every one of you a piece of New York pizza. Maybe once Bitcoin hits $1 million, they'll allow me to do that, but not today, unfortunately. We do have two guests, though, on the show today. So there you go. I'd say that's a pretty great trade-off. And with that, welcome to another episode of Markets Daily. I'm your host, Helene Braun. What a week it's been in crypto markets so far. It looks like the spot Ether ETFs might happen after all. If you missed all the recent developments, don't worry. We'll be breaking it down for you in today's episode and make sure you're all caught up ahead of an important decision tomorrow. We'll also discuss today's vote in the House of Representatives on the Financial Innovation and Technology for the 21st Century Act, also known as FIT21. The bill is supposed to establish the roles for both the SEC and the CFTC in regulating crypto. So a pretty big deal. That'll happen later this afternoon. But first, let's have a quick look at the market, which is looking pretty red across the board this morning, not continuing the rally from earlier this week. Bitcoin is back below the $70,000 mark, and Ethereum is at $3,714, about a percent lower over the past 24 hours, but still 20% higher since the start of the week. So not too bad if we zoom out a little. As you can tell, we have a lot to cover today. So let's bring in Opimas CEO and founder Octavio Marenzi and Kyle Bligen, Director of Financial Policy at the Chamber of Progress. Welcome.
Glad to be here. Thank you for having us.
Thanks so much.
Awesome. This is the first time we have two guests on the show, and I do have a million questions for both of you, but I do want to open it up first and let you guys take us where your heads are at. So, Octavio, let's start with you. What's your call of the day?
Well, I don't know if I have a call of the day, but certainly something that's at the top of mind, and I keep looking at it very, very closely, is basically what the Fed is up to in terms of interest rate policy. So that seems to be something that's going back and forth, and we've seen sort of a shift, I think, now overall away from a consensus that the Fed was going to cut interest rates at some stage this year, and that seems to be disappearing over the horizon further and further. I'm starting to think we're much more likely to see an actual hike in interest rates as inflationary pressures don't come down and markets just seem to be going higher and higher and higher. And the Fed basically looks at that and says we have to rein that in at some stage. So that might be very, very negative for markets overall, for cryptocurrencies certainly suffer from that kind of environment, but we'll see what the Fed comes up to. But I think the balance of the risks are basically the Fed shifts to actually increasing interest rates rather than cutting them anytime this year. So that's what I'm watching. That's not a trade of the day. I don't really do predictions a day ahead of time. It's so hard to do and sort of a fool's errand. But I think that's something we need to watch very, very carefully and closely.
Kyle, is that something that you're watching too, or is that an opinion you share?
Yeah, I mean, I do think the broader, if you're tracking the market right now, I do think watching the Fed would be smart, whether you're a consumer or an investor. What the Fed does impacts markets, and that's true. But I would say my call of the day is hopefully, it's my prediction that the vote that happens today on the House of Representatives is going to be broadly bipartisan. That's my call. Hold me to it, and I'm excited to see what happens later today.
Awesome, and we'll get to that in a second. I do want to briefly talk about the sudden developments on the spot Ether ETF applications this week. To briefly recap what happened for our listeners, basically the odds for an approval were very low up until Monday when reports came out that issuers had been asked by the SEC to update their 19B4s ahead of Thursday, which is a key deadline for the SEC. However, there are two components to this, and the other one is the S1 document, which the SEC could technically still deny, and it could pretty much take indefinitely for the SEC to make a decision on that. Nevertheless, this is a good sign, but I want to ask you, Octavio, what do you make of all of this? And then, Kyle, I want to hear your opinion too from a regulatory perspective, but let's start with you, Octavio.
Well, I think the SEC has expressed its sort of very dim view of cryptocurrencies repeatedly And if we look at the very painful, arduous approval process to basically get Bitcoin spot ETFs across the finishing line, they did that kicking and screaming. But once that decision came down, I mean, they only did it because the appeals court back in August decided they had to do it, and they didn't like the reasoning the SEC had given for denying those ETFs to move forward. I mean, the same reasoning would have to apply to Ether ETFs as well, or maybe even any asset class. Basically, the appeals court was saying you need to articulate clearly why you're going to deny this application, and what you provided was not clear enough. So once that precedent was set, I think I wouldn't say it was a foregone conclusion that an Ether spot ETF would get approved, but I think the odds were very, very strong at that stage. And now the SEC doesn't like cryptocurrencies. I think they've made that clear. Even when they've approved these funds, they basically warned investors, you should be very, very careful about this stuff in a way that they really don't do with other funds. So they seem to be sort of taking positions and giving guidance and advice that usually they wouldn't do. So that's unusual. But so I think the odds that the Ether ETFs get approved are very high. And now we're seeing that DTCC has actually listed them, and they've warned the exchanges that's going to happen. So I think the SEC doesn't like cryptocurrencies, but even less than disliking cryptocurrencies, they dislike losing court cases. And so that's, I think, what they were afraid of. They were going to get hauled back into court and go through the same process and lose once again. And they like that even less. So I think we're going to see these Ether ETFs basically be approved, begrudgingly perhaps, but they will be approved.
Kyle, from a regulatory perspective, why do you think the SEC changed its mind about this?
I think similar to what Octavio said, the SEC has obviously been very, very critical about the digital asset class, but I think they're seeing the trend, not only what's happening in Congress, but also the sentiment of the courts. I think they recognize that the tide is definitely turning, and they need, for their own benefit, institutional integrity, they need to follow a consistent rulemaking and approval process. And I believe that hopefully, if you're an investor, an approval for this ETF is going to be a great thing. But the regulatory process needs to be worked on, and we'll discuss that later on.
So some of the issuers who initially were going to offer staking took that off of their filings this week, most likely because the SEC told them that they wouldn't allow it. What do you think of that decision, Octavio? Do you think it's good, it's bad? Do you sympathize with this decision? And is it going to make these ETFs less attractive to investors?
Well, certainly will make it less attractive. I mean, there's some portion of investors who are interested in the staking side of things. I guess the argument is basically if you're engaged in staking, you're starting to almost operate like a bank in the sense that you're taking deposits and you're lending it out and you're giving interest returns on things that people are holding with you. And I think that's some of the arguments that against previous providers of sort of staking services, the courts have made, and prosecutors have in fact made, that this is basically a banking activity that you can't or shouldn't really be engaging without a banking license. So I think it's a separate regulatory issue there. But certainly it's going to make it a bit less attractive to some of the people looking to invest, but not overall. I think it makes it sort of cleaner, really, overall, that you're basically investing directly in Ether through an ETF without some of this noise around the edges. So I think that's fine overall. There's a small portion of investors who will be turned off of that, but I think it's very small overall that will say, okay, if you're not going to have staking, well, I'm not interested in your ETF then. So I think we're not going to see them really lose an enormous number of investors as a result of that.
So as mentioned earlier, the House is going to vote on an important bill today. Kyle, can you just very briefly explain again what this bill is about and why it is so significant for the industry? Sure.
So there's three key reasons. I'll break the bill down. First, the FIT21 Act provides consumer protections. Right now, the main talking point from the SEC and opponents of cryptocurrencies is that the industry is rife with fraud. There's bad, malicious actors running around everywhere. Well, this bill speaks specifically to that consumer concern. It applies the Bank Secrecy Act to every single exchange that allows for the selling of assets and commodities. The same Bank Secrecy Act that regulates all their financial intermediaries in the status quo will now be applied to the digital asset space. So bad actors looking to avoid taxes, allow for money laundering, and allow for the proliferation of criminal activity on their exchanges will now have to comply with that established broad-based regulatory regime. The next thing that it does is it ensures that there's this nice desegregation of consumer assets within these firms, which is a problem that we saw with FTX. So consumers are being protected in this bill. Next, we see that it provides for consumer stability, which means that the SEC and the CFTC now have to combine and propose joint rulemakings to oversee what will be determined to be as a digital asset or a digital commodity, which means if you're a consumer, there's not going to be any more of this back and forth about whether or not what I'm purchasing and what I would like to sell is a security or not. We've recognized that investors and consumers do not want to play regulatory ping pong. They want regulatory certainty. This bill does that. And then lastly, I would say it increases financial inclusion for all. Pew Research found that almost 20% of Black Americans, Hispanic Americans, and Asian Americans utilize cryptocurrency, buy it, sell it, trade it, right? Which means that a significant amount of the American population right now is already utilizing cryptocurrency is here. It's not going away. It's just whether or not we embrace it and allow for there to be consumer protections and guide rails to allow for the most amount of Americans to have access to this product. And then if you're asking me if I think it's going to hopefully go through, I believe it's going to be broadly bipartisan. I think it's important for your listeners to know that this bill passed the House Financial Services Committee and the House Agricultural Committee on a bipartisan basis.
So that all sounds like a very positive development, but I saw that the SEC chair, Gary Gensler, said this morning or yesterday that this bill would hurt investors. Why is that? What am I missing here?
Yeah, correct. I mean, as we spoke about previously, the SEC believes they already have the regulatory authority to oversee all digital assets. But clearly, in a multitude of court cases, that's not true. There is clear uncertainty in the market of what is a security and what is a digital commodity. Gary Gensler wants to hold on to the regulatory regime that the SEC already has. However, the CFTC and their chair Benham is actually going to be on Capitol Hill today, telling a completely different story. He's going to be discussing with members of Congress that the CFTC right now needs additional authorities to oversee digital commodities, which a significant amount of these coins that the SEC believes are securities. We're going to find out through additional rulemakings and through the passage of this bill that a lot of these digital assets are commodities. And this bill gives the CFTC the funding that they need to ensure that sellers of these commodities come into compliance with the law.
Octavio, do you agree with Kyle here, or are you on Gary Gensler's side?
Listen, I think what Gensler is basically saying is that if the SEC doesn't regulate this, it's going to be an absolute disaster. And we need to have the SEC regulating everything, and the SEC needs bigger budgets and more people in order to regulate this, which is the way regulators always speak. So I'm not surprised to see this sort of fight break out between the CFTC and the SEC. It's been going on for some time. Sometimes this fighting between these two regulators has led to really perverse results. Like decades ago, back in sort of the 1990s or even earlier, the CFTC and the SEC couldn't agree who should be regulating single stock futures. That means a future on a single stock like Microsoft or Intel or something like that back then. And as a result, that trading just got banned. And you could buy single stock options, but you couldn't buy single stock futures until Congress came out with a new piece of legislation in 2000 to basically clear that up and allow that. But they really stymie markets sometimes. I wouldn't be surprised to see some sort of outcome like that in this space. And I think Gensler might quite like that if he were to say, basically, we can't agree who regulates it, so we're just going to ban it. Now, I don't think that's going to be the outcome we see here. I think there's broad-based support behind pushing this forward. But I wouldn't be surprised to see Gensler push in that direction. Say, well, if we can't regulate it, well, then we should ban it and not do it. But so I think his comments here basically are very self-serving and a bit disingenuous in terms of how he wants to see digital asset regulation go. He wants to be the one regulating it, and he doesn't want to give up the control to the CFTC.
So is this bill something that, innovators in this space are watching, or is this something that, is eventually going to impact markets too? today's decision and how it's going forward?
I've already seen a broad amount of support from crypto entrepreneurs, crypto founders, and crypto investors. Just yesterday, I was in a conversation with some of my congressional colleagues, and they received a letter from a multitude of Black crypto founders and an HBCU talking about the building blocks of wealth in the new economy could be following digital asset regulation. Right. So I do think if you are in the market right now and you are looking for opportunities to diversify your portfolio, the possibility to build wealth and be a part of new developing technologies, you need regulatory clarity. And this bill seeks to provide just that.
All right, Octavio, any final thoughts on this?
Well, I think overall, in this space, I've been surprised by the calls for regulation that's come from the innovators. I'd never seen that before in any financial instrument. It's always been quite the opposite, that someone's come up with a new financial instrument, take credit default swaps or something like that. The regulators didn't know what they were, took a decade and a half to try and figure it out and come up with some regulations. And the financial institutions who introduced them were very happy with that state of affairs and didn't want them to be regulated. However, I think what's happened here is, as a result of limited regulation, institutional investors have basically sat on the sidelines, have not got terribly involved in it, only the margins a bit, because they're sort of afraid of the asset class. And so this regulatory clarity is going to help that and push things forward. And I think will bring a lot more investors sort of into the fold. People who might have not invested in this asset class in the past will come into the fold and say, okay, there's greater clarity now, there's lower risk, I can go ahead and invest. This is a respected, established asset class. It's not something exotic and weird and wild. We can actually justify and tell our investors, our institutional investors, that this makes sense to do.
Well, that would be the goal, but we'll definitely be watching today's discussion and vote. Thank you both so much for joining us this morning.
Thank you for having me.
Thank you.
That was Opimas CEO and founder Octavio Marenzi and Kyle Bligen, Director of Financial Policy at the Chamber of Progress. Thanks for listening to today's episode. I'm Helene Braun, and I'll be back with an update on the vote and, as always, a fresh market outlook tomorrow. So I'll see you then.